What's good, day traders? Welcome to day number 16 of the bootcamp. And today we are going to be talking about moving averages. This is an indicator that I have a love and hate relationship with because I try to not tell people about this indicator because a lot of people use it as the signal to enter trades. But in reality, this is something that you can use correspondent to your analysis, like we spoke about yesterday with the Fibonacci retracement tool, and use it correspondent to your analysis to make better judgments and better trades. Okay, so today we are going to look more into how we use moving averages, what we can do to utilize it, and how we can use it as one of our confluences. Now, like I said yesterday, guys, just because we have a good entry signal from a moving average does not mean you just use it by itself. You have to use it with the confluences that you have, or your primary confluences that you have with your technical analysis, i.e., price action, candlestick formations, and your entry protocols and things like that. Okay, this again is a secondary protocol or secondary confluence to your market analysis. I repeat, guys, it's a secondary confluence to your market analysis. So, for example, if I have a very strong buy signal and I see that a set formation with the moving averages, I can then use it as a confluence, but it has to be secondary because I already have my entry signal. Likewise with a sell, if my moving average is giving me that sell signal, it has to be correspondent to my analysis so that I can validate my work. Okay. So with these things, I would use the moving averages in a way to just give me that confidence with my entries and my targets. Okay, just that confidence. And with indicators, guys, you need to understand that these are just things that are going to help you build confidence. That's all it is. So, for example, fair value gaps, support and resistance, candlestick formations, all of this is just building up confidence, building up a story for you to place the trade. Okay, because we can place buys and sells wherever we like, it's our free will, but these things just give us the extra confidence, the extra boost to place better trades and get better outcomes to our trades. So, guys, we're going to look at the moving averages that I personally use. Now, guys, I've been through so many indicators. I've gone through RSIs, ATRs, and I'm going to be honest with you, I just feel like all of this is a load of distraction. This is something that just kind of diverts you from what's really happening in the market, because at the end of the day, this is all delayed. This is not real-time analysis. These are just delayed data that's getting projected to us. And if you know anyone that's solely trading based off indicators, unfortunately, guys, I personally do not feel like that is the way to go with trading. Okay, that's just my personal opinion. If you trade with just a moving average, for example, and you're successful, totally fine. That's just between you and the markets. But for me personally, especially when it comes to trading and having that longevity of trades, I'd say that indicators are just secondary and they can never be primary. I would never go based off a signal based off a moving average, RSI indicator, or a ATR pip count or whatever it is. I will not go based on just that. Likewise, I wouldn't go based on just support and resistance. I need to build up a load more confluences for me to place a trade. And the reason why I'm like this is because a lot of you will realize that when you're trading, you will take few losses and you will need to build that confidence back. And the only way you can build that confidence is by giving yourself more confluences, right, to place the trade. So for me, I've taken way too many losses to just go based off one or two confluences. Okay, so likewise with you guys, I would recommend no less than one to two primary confluences, i.e., support and resistance, candlestick formations, the patterns, chart patterns, those things. And then the third confluence and fourth or fifth, whatever it is, can be, for example, moving average, for example, Fibonacci. Okay. So yesterday I showed you the Fibonacci retracement tool. And today I'm going to show you the tool, the second tool that I use to give myself better entries, better confluences to back my analysis. So I already analyzed Euro USD. This is my analysis from last, I think, 2 weeks ago. And we're pretty much in the same notion. I can go on the daily time frame. We're pretty much on the same kind of movement, right? We already had that push to the downside, and obviously we're starting to see an upwards push, but my bias is still going to be bearish, and I'm going to explain to you how we can use the moving average to determine what our bias is as quickly as possible. Okay, but first thing first, guys, I need to show you the moving averages that I use. So for me personally, I use the SMMA. There is something called SMMA and EMA. SMMA is smooth moving average, basically. And the EMA is an exponential moving average. Okay. Exponential moving average is much better. I would use the EMA, and I've used it in the past. But for my trading style, I like the SMMA. A little bit more smoother, a little bit more, it's a bit more delayed, but it's not the worst thing ever. And it's, exponential moving average and, smooth moving average. They're pretty much side by side. If you prefer EMAs, which I have done in the past, guys, you do not need to, think, oh, if I'm using SMMA, I have to use that. If it works for you, use EMAs. They're both exactly the same. Just one is a little bit more accurate. The second one is a little bit more delayed and it's a bit smoothed out. So it's not as accurate. But at the end of the day, guys, this is what suits you, okay? And I'm going to go through the charts with you as well to show you the differences between this. But the first SMMA that I have is number 8. Okay, this is the input. Please take a screenshot or pause the video, add it onto your charts. Okay, and so this is the first one, and I have it in blue. Okay, the reason why I have it in blue is because 8 means that it is giving me an average of 8 previous candlesticks. Okay, that's pretty much what SSMA is, or moving averages are. It's the average of where price has gone to. For example, it will calculate 1, 2, 3, 4, 5, 6, 7, 8. It will give me 8 of these candlesticks and the price of where candlestick closed. It will give me the average of this and then be plotted as a line graph. Okay, and so that's pretty much how it is when it comes to the moving averages. Okay, this is for both moving average, and then the second moving average that I use, which is kind of works together, and I'm going to show you why, is called the 50 moving average. And again, the style is red. I like to have this in red because it's a little bit more further apart, and it's clear on the charts, and I can see it visibly as well. There's no particular choice when it comes to the colors. You can choose the colors however you want. It doesn't have to be exactly these colors. If you want it purple, have it purple. If you want it green, have it green. It does not matter. Okay, just make sure that you do not use too much hideous colors that you start to get diverted in what the market's actually showing, and you're concentrating only on these lines. Okay, the aim of the game is to use this as a backing tool rather than a attacking tool in the market. Okay, so this is more of like a defensive play rather than an attacking play. The attacking plays will be more like the price action, whereas this is just defending what our price action is saying. Okay, so when it comes to the red and the blue, one tip, okay, and this is just notes that we're going to keep. Okay, number 1, if moving average crosses over, and I'm going to show you an example. If moving averages crosses over, that could mean a change of trend. Okay, this is tip number 1, guys. If moving averages cross over, that could mean a change of trend. For example, we were going on this uptrend. Okay, you guys can see this nice, lovely uptrend. Okay, price decided to come down and retest the down and then continue to go down, breaking this structure right here. Breaking this structure. And then what you can see over here is the moving average has also given us that confirmation that we are now on a downtrend because we had the moving average cross over. Okay, simple as that. Again, let me show you another thing. Okay, over here we had another moving average crossover. Why? Because we had price come on this downwards trend. Okay, price then ends up reversing to go up. Okay, and then once it was reversing to go up, right, we end up seeing that price crosses over at this point, okay, giving us that signal that price is continuing to go up, okay? Now, as you can see over here, we actually have price crossing over a load of times. And what this tells me is this is a consolidation box, okay? This is a consolidation box. And as you can clearly see, we have that break of consolidation, retest, and then push to the upside, okay? Again, another easy way to identify consolidations is if moving averages just keep crossing over time. We are on the daily time frame. On the lower time frame, it'll be a little bit more shorter. Obviously, in the daily time frame, you can clearly see that price is just going up and down. But on a lower time frame, you'll see up, down, uptrend, downtrend, uptrend, downtrend. But in reality, what's happening is price is just consolidating from one level to the next, okay? So every time you see moving average crossover, it just means a bias, a trend of the change of trend bias, okay? So for example, here, uptrend, there, downtrend, okay? So in order for me to determine, okay, that we're having a change of trend is if moving average, this one goes up like this, and then this one decides to go crossover like this, crossover, and go up like this. And then this one's obviously making it up. If this happens, right, and we see this crossover, then yes, we have now had a change of trend. But guys, I want to show you something. The reason why I say you cannot use this by itself is because have a look at this, okay? For example, here, we see a crossover, okay, right over here. And again, this is all delayed, by the way. So this is not exactly at this point. This happens after a few hours, okay? Or a few days in this case, okay? But in reality, guys, right, we had that internal breaker structure, which is over all the way up here in reality, right? We had this internal breaker structure all the way up here. Okay, so we've technically missed out on all of this, okay, until obviously the crossover. So we've technically missed out on around, I think, 225 pips, okay? And then, not only that, if we decided to go off based of this moving average, right, will be this candlestick, and we went for a sell, look what happens. We go for a sell, stop loss obviously above the high or whatever we want. Let's say we just keep it above here. Look how big of a stop loss it is, right? And then what happens? Price goes up to give us a better signal, okay? So tip number 2. Okay, tip number 2. Entries are best found at retest of moving average, okay? Entries are best found at test of moving average. What do I mean by this? Well, guys, we have this break, we have this retest, and price not only retested our key level, which is 1.09500, it retests our red moving average, which you can see over here, right? Giving us a really good signal, and then us potentially going for a sell. Let's just say we go for a sell here, stop loss above here, targeting obviously whatever we want to target, okay? Giving us a nice 1-to-3 risk-reward ratio, okay? So again, most entries, and don't just go based off the moving average, because you would obviously get, for example, here you would think, oh, break of moving average, we're going down, but clearly we didn't, right? But then look, we retested this moving average, we had that breaker structure, retesting this moving average, giving us a nice buying signal, okay? But guys, remember, don't go based off this information. Go based off all your analysis first, and if it taps into your moving average as well, brilliant, okay? So that's another point that I want to share with you guys with the moving average. Another point that I'll give you is a number 3, right, which we'll put over here. 3, sometimes, and only sometimes, it's a good signal when you place your stop loss above the moving average, okay? So for example, if let's scale into a lower time frame, for example here, okay, we have had obviously a great bearish signal, okay? Price has broken moving average, rejected our key level, and given us a nice market structure, okay? Break and retest, okay? And a nice candlestick pattern. Let's say we entered over here. Now, we don't want to keep our stop loss all this high. What we can do, right, which we enter on this candlestick, we can keep price above the moving average. Okay, sorry, our stop loss above the moving average. What does this do? It keeps our stop loss very, very nice and tight, giving us a higher risk reward ratio. So for example, this is a 1 to 5, whereas if I kept it above here, it would be a 1 to 2. Okay, so it's a big difference, huge difference in my opinion, and it can be a game changer. Now, like I said before, it might not always be like this. You won't, this is just something that is happened. It might not always be like this. Obviously, we have the crossover here. So most likely if price decides to go above this crossover, we would know that, you know, price is very bullish. But in this trend of the way we're going, we already know that we're bearish. So in this move, it's very, very clear that it's happened. But for example, if I went for a buy over here, right, and I kept, let's say we went for this lovely buy over here, right, even though it's against the trend, which I do not recommend, but let's say we do go for a buy over here, right, stop loss just below, you see you will get stopped out. So in some cases, you want to keep your stop loss below market structure. But if your stop loss is like, for example, here, guys, you can always just keep it below here. If anything, place 2 trades. Place another trade or have another order ready for yourself if price does decide to spike up. And that's how easy it is when it comes to moving average. But again, you will not use the moving average just by itself. You would use the confluences of your trading first and then use the moving average to back. For example, placing stop losses. Okay. And the last one is actually kind of important. Number 4, okay, is moving averages are a good way to find trends. Okay, what I mean by this is, let's go back, or actually we can stay on the 4 hour. Okay, if moving average is above price, we are in a downtrend. If moving average is below price, we are on an uptrend. Okay, above, and I'm actually going to write this down. Above, if moving average, so moving average above price equals downtrend. Oh, downtrend. Moving average below price equals uptrend. Okay, my spelling is terrible today. Okay, and I'm just going to put this in another color if I can. Let me just boom, like this. Okay, moving average above price equals downtrend. Moving average below price equals uptrend. Example: moving averages is above price. Put it here. Moving average is above price. This is a downtrend. Continuation of a downtrend. Continuation of a downtrend. Even though we're slowly building structure of price going up, we're still a downtrend. Simple as. Until price goes above both moving averages, we are still on that downtrend. Okay, over here, price is above the moving average, uptrend, below the moving average, we're still on uptrend. Here is where we start to get to a downtrend, but clearly price did not want to stay in that downtrend. We continue to go up. Again, price is very close to the price, right, to the moving average, meaning that we're still following through. The more further away these moving averages are, the stronger the push, the more the volatility. If the moving average is very close, we're getting some sort of consolidation. If the moving average crosses over, we are changing direction, and so forth. Okay, that's how we are going to trade with moving averages. Okay, now guys, like I said earlier, do not use this by itself. Okay, please do not use this by itself. Okay, you have to use it as a secondary confluence. Okay, 9 times out of 10, you won't even see me with moving averages. Okay, I'll only have the moving averages there if I'm a little bit confused with price or I want to get that extra confluence. That's the only time you'll see me have that moving average. Most of the time, I'll have it hidden because I don't need it, because I have trained my eyes to see how the trends are. I've trained my eyes to place the trade without this moving average. The less indicators you can use, the better it is for your trade. You don't have to bombard your chart with indicators. You can use the chart. You don't have to use all the indicators, okay? If you can read price on a naked chart, that's better than you bombarding yourself with so many indicators, because some indicators can contradict each other. Some indicators can say we're on a bullish trend, another indicator can say we're in a bearish trend, and what would happen is you're confused and you miss out on some pips, or you place the wrong trade based on these confluences or based on these indicators, and then you're blaming an external thing. The market is not based on externals, okay? If it was that easy, we wouldn't be sitting here right now, trying to find methods of placing trades. Everyone would have the same strategy, okay? So the reason why I'm explaining this to you guys is because a lot of you are bombarding your charts with so many indicators thinking that this is going to stabilize yourself within the markets. That's not going to happen. The more indicators you use, in my opinion, it means that your brain is messed up and you can't read the simple charts, okay? The charts being naked, for example, is much simpler than you bombarding yourself with all these indicators, and now you have to put yourself out there and know what these indicators do, and it's confusing and you're learning too much, okay? The best advice I can give you, and these are for the people that have watched the video to the end, the best advice that I can give you personally, okay, is learn less and practice more, okay? The reason why I say this is because for me, I learned way too much, okay? I learned way too much to the point where I became blinded by what reality is, because that's what the market is like. So if you can learn less, practice more, and keep trading easy, you'll be good. The only time trading will become difficult is if you make it difficult. Okay? For example, your psychology, bombarding your screen with so many indicators, not keeping a clean desk, not having your environment clean. Okay? So making sure that you are focused, making sure that you're not letting these external things affect you is the best thing in my opinion. Okay? I had to unlearn a lot of things because I was so obsessed with learning, when in reality, I should have been practicing more. Okay. So for today's homework, I want you to practice moving averages. I want you to use it. But most importantly, I want you to backtest your strategy. Okay. That's today's homework. I want you to backtest your strategy. I want you to backtest using price action, and then adding on that confluence of the moving average. Okay, so that's your homework for today. I'm going to repeat it again for the guys that did not understand. The homework is backtesting your strategy and adding on the confluence of the moving average to the strategy to make sure you have that extra confidence. Simple as that. Okay, do that a few times. If you can give yourself an extra 10 trades, do that. Okay, and for you guys that are struggling with backtesting, no worries, because we are going to be doing a video on backtesting. I'm going to show you how I backtest, especially if you don't have the replay bar, right? I'm going to show you exactly how to backtest and the easiest way to backtest without the replay bar. And it's completely free, so you guys can learn and still make money while forward testing and backtesting, okay? But that's for a later bootcamp video. Guys, we're at the end of today's bootcamp. And I hope you guys have learned something new with this indicator. I hope you guys take in my advice with regards to the markets and keeping things simple. Make sure if you have any questions, drop a message on the comments. The Discord server is completely free. You can always just click the link down below and join the Discord server. We are a very welcoming family, very welcoming group, and we're all trying to help each other gain to a successful trading journey, basically. So if you are a trader that wants that support, that wants those type of friends around you that are pushing you to make success and keeping you disciplined, join the Discord server. You're not going to regret it. And also, guys, if you enjoyed this bootcamp, make sure to give this bootcamp a like, share it to your friends, subscribe, do all those things. And I'll see you guys in tomorrow's bootcamp. See you later, guys.